Hello and welcome. You're watching Business Plus. Demand for luxury property is on the rise. Luxury realty major DLF recently sold as many as 1,137 luxury apartments priced at 7 crore and each and above, in fact, in its housing project in Gurugram, amassing a total of 8,000 crore just within 3 days, reflecting a strong demand for premium flats across major cities, especially in Delhi and NCR region. DLF says that it has witnessed record-breaking pre-formal launch sales of 8,000 plus crores for its luxury high-rise residences, the Arbor. Now, in a regulatory filing, it further said that it will be building a 1,137 4 BHK apartments across 5 towers in this 25-acre project. The project has been fully sold out within 3 days, even before its launch. The phenomena is not limited to DLF. There is a mad rush for luxury properties in India. What exactly is driving the people to buy luxury goods, especially homes? And remember, for instance, as many as 9,268 residential units in Mumbai were registered in February alone, of which 13% properties were priced at 2.5 crore rupees or above. This according to a Knight Frank report. We are, of course, going to talk about the luxury real estate market. With me in the studio is my colleague Karthik Malhotra. Also joining us at the moment, I think joining us very, very shortly will be Amit. I want to come to you first, Karthik. What exactly is driving premium property market?
Well, honestly, to me, it seems, Shweta, that people have run out of other items that they can splurge on. There's only this much that you can do in terms of buying gold or buying cars or buying expensive watches. What really surprises me is the fact that there are over 1,100 people who are queuing up outside the offices and the construction site of the Arbor, and really going ahead and making purchases of 7 crores and upwards. Seems a bit of a shock and a surprise both, where at one point the government is talking about affordable housing and real estate dividends. The yield from real estate has not particularly been very high as an investment option. As I understand, these are ultra rich people who have a home, if not a couple of homes, maybe half a dozen homes already. And this is definitely a third, fourth, fifth house that they are buying. Of course, the amenities, you can see the visuals, look at the house. I mean, it's absolutely beautiful. This must be the sample flat or maybe some graphics representing the sample flat. It's absolutely gorgeous. It's a high tower, multi-story apartment complex, absolutely plush. And Gurugram, of course, we've seen has really picked up a lot of steam when it comes to investing in real estate. The big question is, are people really looking at this as an investment option or really looking at living in these homes? But I think the larger discussion here really is about the fact that is real estate as lucrative an investment option as it was said to be till a couple of years back. People were under the impression that, you build a house, you buy a house once, and it's going to give you dividends in terms of both capital appreciation as well as rental income for generations to come. So are people still looking at real estate in the same light or not? I think that is something that we'd rather understand from a financial advisor, which I am not.
Okay. Amit is joining us at the moment. Amit, who's the founder and CIO of FinTech Capital. Amit, I want to come to you and ask you the same question, as a matter of fact. What exactly is driving the premium property market? Because we've seen a slump in 2019 and suddenly there is a spurt. What exactly changed?
Yeah, hi, thank you for having me. So I think after the COVID lockdown happened, people realized the need of extra home. So that was true for affordable housing as well as luxury housing, both segment. But I think in the past 6 months or so, or probably a year or so, we have seen a much more sharp rise in the luxury segment, and this is despite high interest rates. Coming through. So the high interest rates segments has impacted the affordable housing. The EMIs have really shot up. But I think in the luxury segment, the demand is not so much impacted. In fact, due to the recent budget regulation changes in one of the clauses, the impact towards the financial year end has picked up. So if you remember in the budget 2023, they had a clause that capital gains from selling any property more than 10 crores, that will be taxed. So if you're buying a property and you are investing into another property, and if your capital gains are more than 10 crores, the first 10 crores are tax free, and then you have to pay capital gains depending on your slabs. And usually these slabs are at the highest level of 42%. So I think in very short term, the projects which are seeing a very high demand in the luxury segments, a lot of that buying is basically propped up by the tax saving angle, and this might slide a little bit in the new financial year. But we also need to see that the K-shaped recovery which has happened due to COVID, that has sort of made these luxury homes a little more incentivized for the rich people.
Mhm. Amit, just a follow-up question on that. So, are you saying that this is just temporary, right, before the new financial year begins, and there's going to be a capital tax on property that you're buying or selling over 10 crore? Does that mean that this is just a temporary affair, and sales of luxury properties is going to halt or not be as much as we have seen in the last couple of weeks?
So just to clarify, there is no capital gains tax on more than 10 CR or so. The clause is that if you're selling any property, then under Section 54 and 54F, you could have reinvested those proceeds in tax-free bonds. Now that is limited to 10 CR only. So only up to 10 CR it will be tax-free, and anything above that will be taxed. So I think that has sort of bumped up, luxury home sales in the short term, and I expect that in the next financial year, this demand would certainly drop a little bit from the current levels.
Right, Amit, talk to us about the yield and about the overall dividend one gets by investing in real estate as compared to other investment avenues, including stocks, mutual funds, gold, or even bonds or other debt instruments. How does property or real estate investment pan out? I'm not talking specifically about the ultra rich buying 7 CR and upwards of houses, but in general, what's the kind of capital appreciation plus yield dividend that an investor receives by investing in real estate purely as an investment vehicle as compared to other asset classes?
So again, in this, we need to divide it into a luxury segment and the affordable housing segment. In the luxury segment, there is definitely an angle of capital appreciation happening, provided we are having a real estate cycle after almost a decade. So the last bull market sort of in real estate ended in 2012-13. And now, post-COVID, we have seen a sort of a upsurge in the prices for the luxury segments. I'm not very convinced that the real estate prices can really shot up from here, because whatever has been the luxury segment sales, that is mostly driven by the end usage. So if you look at the commentary given by the DLF in this 7 crore projects also, we have seen that most of this, almost 95% that they've quoted, is actually for the end usage. So basically, the rich people are buying their third home or the fourth home. So I don't think there is a rent angle is very strong there. But in the affordable housing segment, I think people who are looking to buy their second home or maybe third home for rented, the yields are about 3 to 4%, which is definitely less than what they get in a let's say equity market or even in a debt mutual fund. But the idea here is to diversify your investments into various asset classes, and I think that drives a lot of the investments as far as the affordable housing segment is concerned.
So, Amit, you've also handled PMS, and that by virtue of being a PMS manager, you in your previous avatar, and I believe you're getting into PMS as part of your offerings in your new startup also, and congratulations for that. But your experience of having dealt with ultra rich families and individuals of ultra high net worth, what is it that they really try to derive by getting multiple houses? I understand these would largely be business families, And even in a business family, there would be only X number of family members. So what is this craze of hoarding so many houses? Not every individual of the family is going to live in a separate house.
Yes, I agree. It's more of an asset allocation call rather than a particularly bullish call of real estate, or actually the end usage of actually staying in the properties. As you know that stock markets have been down for almost now 18 months, and the returns haven't been that great until unless you go very stock specific. So I think it's a more of an asset allocation call where money is actually coming out of equities and going into debt and real estate. We have anticipated this, quite some time, because whenever you had a very good rally in stock markets, like we saw in 2020 till about 2021 end October, a lot of money. Whenever this kind of rally happens, then a reversal of or mean reversion to that rally also happens, and I think we are seeing that sort of cycle currently. So I agree that a lot of this is not really driven so much by end usage, but a more of an asset allocation call or a tax saving call currently, where people are moving into luxury real estate segment.
Right. So purely as an investment, when you talk about the asset allocation pie chart, how much would you attribute to real estate? I remember earlier when we've spoken, the ideal asset allocation between debt and equity is 30-70. And some people also advise gold could be maybe a 5%, and you can cut out this 5% from either equity or debt, 5 to 10% depending on which investment advisor one is speaking to. But the real estate market and investments in real estate don't really make it to the asset allocation pie for regular salary tax-paying citizens like Shweta and me. So how does one fit in real estate, and what percentage of assets should be allocated towards real estate?
So again, the asset allocation call needs to be done as per the risk appetite and as per the capital which is available, the disposable income which is sort of available client-wise. But as a broad stroke investment advice, I think we are still very bullish on equities, given the stop, long 18 months sort of sideways movement which has happened in the equities. I mean, 1 year ago when the Russia-Ukraine war happened, we were at 17,000 and we are still at 17,000. So there has been a lot of time and price correction. But what has happened is that the internals, if you go into the stock market and you see the broader market, the valuations have really become cheap. And there is a case of if not being overweight, at least have 65% or 60% at least in equities. Again, that would depend on the risk appetite of the investor. But that's a sort of a rough estimate which we are keeping in equity. Again, I think debt market is very efficient. At this point of time, you are getting good 9 to 10% yields in a lot of debt mutual funds. A lot of FDs by the small finance banks are also in that range, especially for the senior citizen category. So again, 30 to 35% can go into that, and the remaining 10 to 15% can then go into the real estate. Or if somebody is really interested in gold, I have not been a very big bull gold investor in the past. I treat it more as a trading opportunity and not really an investment opportunity. So I usually don't keep too much gold into my portfolios or advise according to that. But yeah, so that will be a broader split, 65% in equities, 35% in sort of in debt markets, and remaining in real estate.
Okay. Amit, I want to quickly bring in the COVID factor here. There's been a surge in buying post-COVID. Now, we know that 9 out of 10 ultra high net worth individuals saw their wealth increase in 2022. How much has that got to play into the rise or the spurt in luxury real estate buying?
It did. Actually, once the COVID sort of happened and the lockdowns happened, and we came out of it 6 months, 9 months, down. So I'm talking about a period of, let's say, end of 2020. What a lot of people realized was, especially the affordable housing segment, that they required a second home, and the second home was for two reasons. One could be that they wanted larger homes. And secondly, it could have been that, they just found that, if all the family members come together at one place, then, it becomes a little congested and they would require a bigger home. So a lot of the demand which came in the late 2020 and early 2021 was led by this. But as we, moved forwards into 2021 and early 2022, we saw a lot of sort of K-shaped recovery happening, and the luxury segment really got a boosted from that. We also need to understand that interest rates went on an upswing post the Russia-Ukraine war. So the EMIs became a real big issue for the affordable housing segment. It is quite high for them, and they're paying a lot of more interest. So for example, when they started, when they bought a home, the interest rates were around 6.5%. Currently, they are sort of north of 9%, 9.5%. So that has really hit the pocket, and that affordable housing demand has sort of plateaued, or in fact, it's been on the decline in the last 6 months. But that hasn't happened in the luxury segment. In the luxury segment, because the profitability of these HNIs, or the family offices, or even the corporates which are buying, and it is very clear from the data which we get, on a sort of a monthly basis, that there has been a lot of buying in the luxury segment, and it has got a lot to do with this K-shaped recovery which we had post-COVID. That the rich has got richer and poor has sort of stagnated or even declined in their earnings, and that is reflected in the real estate segment as well.
Right. Right, interesting take there. A contradiction. Rich got richer, poor got poorer. While the demand for affordable housing plateaued, there is a rise, of course, that we're now seeing in luxury real estate housing. Thanks very much for joining us with all those details. Amit, please stay on as we move on to another very important story that is coming in from Patanjali Foods. Both BSE and NSE have put a freezer on the shares of Patanjali Foods held by promoters and promoters' entities over their failure to meet the minimum public shareholding norm. So about 92.58 million equity shares have been frozen. As a result, the stock was locked in the lower circuit of 5% in the early trade, but it did manage to pare some of its losses to end at 2% lower. Now, as per SEBI's rules, a listed entity must have at least 25% of its outstanding shares in public float. In Patanjali Foods' case, the stake was at 19.18% at the end of December quarter. Now, what would happen is that Patanjali would need to sell some of its stake in the open market, which would put downward pressure on prices. As a result, the stock would fall. And that is exactly what transpired in the market today. Amit continues to be with us. So is my colleague Karthik. Also joining me in the newsroom is Suyash. I want to come to you, Amit, first. Tell us what exactly happened with Patanjali there.
Patanjali Foods was not directly listed on the stock exchange. They actually acquired a company called Ruchi Soya, and then they, reverse listed the company, and then they renamed it as Patanjali Foods. Now, what happens is, as per the SEBI regulations or the securities contracts regulations, it mandates that any listed entity needs to have a minimum public shareholding of 25%. Now, in the case of companies getting listed through IBC, remember, Ruchi Soya was actually bought by Patanjali in the IBC, the Indian Bankruptcy Codes. So in that case, SEBI gives a leverage that you can achieve this minimum public shareholding MPS of 25% within 3 years. So for that, when they listed, they only had a public shareholding of about, I think, 1.19%. They did a FPO, follow-on public offer, last year in March, where they offloaded and they increased the MPS, minimum public shareholding, to 19.18%. But they are still short of about about 6%, or 5.82% to be exact. So I think what has happened is SEBI has said that you haven't achieved this minimum public shareholding limit by the due date, and that's why all the shares of the promoter entities, there are 21 different promoter entities, they have put the shares on hold, so they cannot sell these shares in the market, and they necessarily have to offload these shares through either a public offer or a QIP, or maybe an OFS offer for sale in the coming time.
Right, Amit, I just want to step in here and try to understand from you, what does this mean for retail investors? Is there any impact at all whatsoever with the freeze on the promoters' float as far as the shares of Patanjali Foods, which used to be Ruchi Soya, is concerned? Does the retail investor get impacted in any way?
No, it's a technical thing, which is SEBI compliance, and they have to follow it. I don't think in any way this impacts the business operations of the company, and as a result, it does not create a problem for any kind of retail investors also. Retail investors are free to sell their shares or buy the shares if they want into the markets. The hold is only for the promoters holding, which is about 82% approximately. There is no as such impact on the retail shareholding. They are free to buy and sell. Again, there is no impact on the operations of the company. They will continue to happen accordingly. But the only the issue is that the company needs to take a call to appoint investment bankers and try and do this 6% sale within a certain period. I think the date which they have given is April 23rd of next month. They need to appoint investment bankers and then do it. So I think it will be a 3 to 6 month process. Appointing bankers, doing the due diligence, creating all the documents, eventually doing the offloading. That's going to take some time. So yeah, a little bit of that issue is there, but it's more technical in nature and not so much operational in nature.
Right. So help me understand here, Amit, what would have transpired in the last couple of weeks or months? Because when the Patanjali Foods float was offered in the market, they would have obviously subscribed or opened 25% to the public, and I'm assuming that at some point the retail stock would have been 25% and upwards of that. So has the promoter bought back shares from the open market for the retail holding to have come down to below 20%?
No, promoters have actually sold in the market, and retail investors or other institutions have bought it. The major of these transactions happened in the last year FPO, which happened in the March 2022, and there a lot of institutions, along with mutual funds and a few PMSs also participated in that. And the stake which Patanjali promoters sold in the market, that was bought by these institutions. So it has been a direct sort of transfer from the promoters to these institutions. That happened in last year FPO. The actual selling by the promoters, I don't think that has happened in the market. In the open market, at least, it hasn't happened.
Right. So, any other such case in recent history that comes to your mind when a situation like this could have happened with another company? And part two of that question, this 25% rule that SEBI has imposed, how long has that rule been in practice, and how's the situation globally? Is there a similar rule in other markets as well?
The 25% rule has been always there in the securities contract regulations, which was drafted in 1957. That has been always there. The only change which has happened under the category where Patanjali falls, the issue is that if you are buying a company through IBC, you get 3 years to achieve that 25% minimum public shareholding. So that is the only issue that has happened. As far as the promoters shares blocked are concerned, I cannot recall any company in the recent past, But in the 90s and the 2000s, there have been a few companies where that sort of a thing has happened. But a lot of companies, shares also get sort of blocked because of compliance. So they haven't paid the listing fees, or they haven't achieved the minimum public shareholding. These kind of things happens. If you recall, recently ICICI Lombard also had an issue where ICICI Bank had to sell some shareholding in the company to achieve a minimum 30%. So the rule is that a bank cannot have more than 30% shareholding in an insurance company. But then they were not able to find a buyer, so they went to RBI and got an extension of 18 months to achieve that. So sometimes the extension also happens. But in this case, because since already the 3 years were almost getting over next month, SEBI decided to sort of block the shares till there is a concrete decision taken on when to sell the shares. I think the bad market conditions had also got to do with the fact that the promoters of Patanjali were not able to sell it. I think once the market sentiment improves a little bit, then you are going to see the selling actually happening through OFS or through maybe a QIP.
Amit, I have a question for you. So instead of dumping the shares in the open market, are there any other avenues for Patanjali?
So for that, they need to appoint an investment banker. I think they're already in talks with a few of them to appoint it. The appointment hasn't really happened till date. I think they have given a deadline in the public communication, which they have done in the morning, that they are going to appoint a merchant banker or investment bankers by next month. And then they are going to, decide what is going to be the mode of selling these shares of 6% shareholding. That could be in the form of a QIP, qualified institution placement, where they are going to directly give it to various institutions like mutual funds, insurance companies, etc. Or it could be through an OFS, offer for market sale, where they'll have a category for the institutions, and they're going to have a category for the retail investors as well. So I think the whole process, how this selling of 6% shareholding will be done, that will be clear in the due time. My sense is it would take 6 months to happen.
Right. Thanks very much, Amit, for joining us with all those details. Appreciate you being with us here on News 9. We'll get you back as soon as we can next time. But we're going to shift focus for now. Global investment bank Credit Suisse said it would borrow up to $54 billion from the Swiss central bank to shore up liquidity and support investor confidence after a flash crash in its shares intensified fears about a global banking crisis. The loan announcement seems to have worked as the shares of Swiss banks soared as much as 30% in today's morning trade. What's more, the Swiss National Bank and the Swiss Financial Market Supervisory Authority yesterday said that the investment bank meets the capital and liquidity requirements imposed on systematically important banks, further dousing fears of a systemic failure. Now remember, shares of Credit Suisse plunged as much as 20% on Wednesday to hit a fresh all-time low after its biggest backer, the Saudi National Bank, said it would not provide further financial support to the bank. Even though it sees Credit Suisse as a strong bank, it is happy with its turnaround plan. The crash in the stock began earlier this week after Credit Suisse said it had found, and I quote, material weaknesses in its financial reporting processes in 2021 and 22. Following Credit Suisse's shocking admission, the stocks in the banking sector, already rattled by the collapse of two large banks in the past week, once again faced the wrath of the bears. And European banks slid sharply in yesterday's session, including 6.8% drop in the US traded shares of Deutsche Bank. The move hit large US banks as well as shares of Wells Fargo and Goldman Sachs fell more than 3%. JP Morgan shared 4.7%, while Citigroup slid 5.4%. Interestingly, Indian banking stocks bucked the trend as Bank Nifty ended yesterday's session with relatively mild losses of 0.91%. Meanwhile, the index ended today's session in the green as well. Joining me in the newsroom is Karthik and my colleague Suyash. I want to come to you first. So Yash, at this point in time, the banking crisis is deepening. But as far as the stocks in the Indian market is concerned, the banking stocks specifically still ending the day in green.
Yes, that's the irony of the situation. We don't understand what's driving the confidence among Indian investors with regard to the banking sector. I think it's the proactive nature that RBI has taken, as we have seen in the cases of Yes Bank and other banks as well. So I think Karthik would like to add to it.
Absolutely. Karthik, the banking crisis is deepening in the US. What are the chances of a systemic failure?
Well, it depends on what part of the story one wants to listen to and who one wants to believe when it comes to this whole conspiracy theory about banking crisis in the US, all over the world, too big to fail, too big to save, it's all going to crash, it's all going to crumble down, there's a great recession coming up. I think there are a lot of angles to explore here. Specifically talking about Credit Suisse, there was obviously a shock across the banking world when we saw SVB go down and we saw Silvergate and we saw Signature. We saw that the confidence that the investors had in the banking sector of developed economies really shatter. And of course, everybody got reminiscent of the Lehman Brothers crisis of 2008, and it was being defined as the Lehman moment for the banking sector as a whole. Now, let's try and understand what really happened at Credit Suisse. Very simply put, its largest investor, Saudi National Bank, did not want to exceed the 10% holding in Credit Suisse. Why? Because there would be a new set of regulations that would kick in as soon as the 10% mark got breached by Saudi National. So I think the real purpose of Saudi National not wanting to infuse more capital in Credit Suisse only stemmed from this regulatory perspective that it did not want to exceed its holding, which is at 9.8%, and take it to 10% and beyond. Fundamentally, and in fact, Credit Suisse has requested Saudi National Bank to issue a statement also formally in this regard. Fundamentally, Saudi National Bank has seen no issue with Credit Suisse. Now, there has been a knee-jerk reaction in the markets. India time yesterday evening around 5 o'clock, 6 o'clock, the story came to light. That's when the Switzerland SIX had opened, and we saw the shares of Credit Suisse tumble. They lost about 20-25%, went down, if I remember correctly, all the way to 30%. And this morning, we are up 30%. So it's pretty much status quo. There was a blip, and there was this crash, and then a boom again. So multiple voices have come globally. Analysts globally are some of them are saying that it's too. So Nuliyal Rubini, for example, has said it's too large to fail, but at the same time it's too large to also be safe. Now again, this statement came India time early morning today, and by then the markets had not opened and one did not see the spike back. And other JP Morgan and couple of other investment firms in the US are giving all kinds of theories, which are contrary to each other. But fundamentally, there doesn't seem to be a problem with Credit Suisse as we saw in the case of SVB. SVB was a completely different story where there was a bank run, and owing to the bank run, there was this massive selling of the stock, and people usually lost confidence in the bank's ability to sort of honor the demands that came to the bank. But fundamentally, Credit Suisse seems to be fairly all right, if you look at it dispassionately.
Okay. Karan Mehrishi, who's an economist, also joining us on the broadcast at this point. Karan, what's your take on what's happening with Credit Suisse?
Hi, thank you very much for having me. So I would like to take attention to the balance sheet of Credit Suisse. Now, the Credit Suisse balance sheet is about $700 billion. Now, that's almost 75% of the Swiss economy. So if you ask me, it will be very difficult for the Swiss central bank to sustain a collapse if it happens, unless it chooses to utilize the dollar swap lines it has with the US Fed and the euro swap lines it has with the ECB. And that is why the market is panicking right now, and you see that through the lens of the credit default swaps spiking at this point in time. So my sense is that the market is expecting that the mess will be very difficult to manage for the Swiss central bank alone, and the contagion, given the fact that so much exposure the bank's balance sheet has when you talk about global assets, which also includes risky assets. And that is why we are seeing the current panic in the market, and the contagion can be hard to manage.
Right, Karan, but if you follow the story as it is developing right now, the shares have bounced back as well. A 50 billion Swiss franc, loan has been issued by the Swiss central bank, and at the same time, that's equal to what, 53, 54 billion dollars, worth of a package. So, I mean, fundamentally, looking at the balance sheet, of course, I think every bank would have a certain exposure to debt. So, fundamentally, is the story in the balance sheet of Credit Suisse any different from what it would be for any other large bank?
That is what I was actually alluding to. Given the fact that the balance sheet is so large as compared to the sovereign GDP, where the bank is headquartered, that is giving markets the jitters at this point in time, because now $700 billion worth of balance sheet. Now if you look at the exposure of a global commercial bank like Credit Suisse, then it has exposure to several structured assets as well. Now, in a crisis, whenever a crisis begins, the first to fall are structured assets. Now, the same situation prevailed during the Lehman crisis as well, when suddenly, as interest rates normalized and monetary policy was affected to reduce systemic liquidity, the structured assets started to fail, and that created the domino effect that eventually collapsed the American and the Western European economy at that point in time. So that is the reason why the market is panicking right now. So it's not that the bank will fail. It's the fear that if it fails, what kind of domino effect it will have on the global financial system.
Right. So help us understand. You're an economist. So help us understand how much of a bailout could the ECB do in this case, considering the fact that Switzerland does not follow the same currency as the euro and has its own central bank. So what is the play between the ECB and the Swiss National Bank, central bank?
So all these, so the US Fed has a dollar swap line, and it includes certain systemically important central banks across the world. Now, the Swiss central bank is part of that system. So what that means is that whenever a crisis happens, then these central banks have access to dollar at a predetermined rate, and they can pay back that dollar loan whenever they have stabilized, as soon as they've stabilized the system. The same arrangement is there with the European Central Bank as well. Now, as far as the bailout fund, as you mentioned, is concerned, then the Troubled Asset Rehabilitation Program, or TARP, which the Americans had instituted during the financial crisis, was worth around $700 to $800 billion, and that was not fully utilized. So we can safely say that they will be using a number of tools, including a rehabilitation package, which the European Central Bank will initiate sooner or later, as well as the dollar and euro swap lines that the Swiss Central Bank will have access to from the US Fed and the ECB.
All right, but coming to, let's say, the fact about about the Indian stocks in the banking sector not really taking much of a hit, do you think this has to do with how robust our Indian banking system has become, especially since the government has come down so heavily on NPAs? Do you think our regulations and our overall structural reforms that have happened in the banking sector, is the Indian investor and the regulation in itself, has it sort of outshone the developed world in that sense? Have we been a little more ardent with and prudent with our regulatory framework in the banking space?
So the regulatory framework is strong. There are absolutely no questions about that. But to answer this question, I would like to draw your attention to the holding of government securities by Indian commercial banks. So on average, Indian commercial banks hold about the assets of a commercial bank in India on average holds around 21% as government securities. The global average is around 9%. So that gives a lot of comfort to the investor, because the high quality liquid assets of Indian central banks, of Indian commercial banks, are very strong, and and that helps in the liquidity coverage ratio calculations. So given the fact that the exposure is not in corporate debt, and the treasury almost 95% holds government debt, which is basically risk-free, gives a lot of confidence to investors when it comes to Indian commercial banks. The same situation is not similar, is not same for global commercial banks, because the treasuries are highly diversified, and they have exposure, as I was mentioning, to corporate debt as well.
All right, Karan, thanks very much for joining us with all those details. But moving on for now, as merchandise exports continue to fall for the third consecutive month in February, the government is looking to take steps to contain imports of non-essential items. Commerce Ministry has provided product-wise import figures to all the ministries. Commerce Secretary Sunil Barthwal said the ministry is expected to look at issues such as if those goods are being manufactured in India and if there is a sufficient capacity for those products. Containing these imports would also help reduce the trade deficit, which has reached at 247 USD billion in April to February of 2022, as against US dollar 172 billion in the same period last year. Remember, imports during the 11-month period of the current fiscal increased by 18.82% to 653 US billion dollars. At the same time, merchandise trade deficit in February stood at $17.43 billion, which is marginally lower than 17.75 billion recorded in the previous month, as both imports and exports are dipping 8% each. My colleague Karthik continues to be with me in the newsroom. Karthik, as exports are falling, the government is likely to contain the import of non-essential imports or non-essential items. How helpful is that?
You know, Shweta, I'm an ardent believer of the GDP formula, right? And I think we've discussed this a few times in the past also. But how do you calculate GDP? What are we really gunning for? I think we are gunning for the fact that we want the country to grow. And when we want the country to grow, we want the GDP to rise. How does the GDP rise? GDP is a function of four critical elements. Number one, consumption. How much is it's an average consumer spending on consuming goods and services? So what are you spending on fuel? What am I spending on clothes? What are you spending on, let's say, office travel? What am I spending on entertainment? What are the goods and services you are buying? You bought a phone, I bought a laptop. You went to a salon, got a haircut. I don't have that opportunity to really experience the inside of a salon. But largely anything that you're spending in the economy is contributing to the consumption side of the GDP. The next is government spending. So what is the government spending on? The supply side management. Government is spending on setting up any center of excellence. Government spending on through schemes which are providing ration to the poor, or any other direct benefit which it is providing to the underprivileged. That constitutes the government spending. The next is investment. Private sector investment as well as government investment. So any kind of infrastructure investment, capital investment, factories being built, roads, highways, ports, airports, etc. All that goes into the third component of contribution to the GDP. Now the fourth one is what is under discussion right now, which is net import. So net import is your export minus import. In an ideal world, you should be exporting more, importing lesser, and the deficit would actually turn to a surplus. Unfortunately, in India, we are still a highly import-centric economy, more than anything else, because we import oil, and oil being a critical driver of the economy and of the industry and public transportation, cooking fuel, etc. So oil being a major import item keeps our import bill fairly high. At the same time, our exports have not been strong. Of course, it's picking up now, relatively, but we've never been an export-centric economy, and our exports have largely been in the services space, not as much in the manufacturing space. So we haven't been an export-centric economy, we've been an import-centric economy. So while there is consumption, there is government spending, there is infrastructure development, investments, these three elements are working well for India. What pulls us down slightly is that we have a fiscal deficit, which means our exports are lower than our imports. Now, the best way to tackle this situation is to give a boost to the export rather than cut down on the import. And why I say this, again, it's important to understand. Let's say an iPhone, which is now being manufactured in India, but let's say another company which is producing an iPhone like phone, let's say costing ₹1,00,000, is non-essential, right? Now, what is the clause that the Commerce Ministry has given here? It's given the clause that you will reduce import if an equally competent product is getting manufactured in India. Are we manufacturing an equally competent product? If we were, I'm sure we would have already reduced the need to import it, because market practices would have come to play. An equally exciting, equally agile product available, made in your country, giving you the same level of satisfaction at the same price point, if not a lower price point, as compared to another which you're importing. So market dynamics would have in any case favored the homegrown product. It would have been cheaper to produce, easier to access, and would not have come with the high taxes that we pay on imported goods. So the point is, you cut down on non-essential imports, but this non-essential import, which is part of the fourth element of the GDP definition, is actually also playing its way into the first part of the GDP equation, which is consumption. So you're paying for the same model phone costing ₹1,00,000 in INR, and there is a tax which is going on that, there's a GST going on that. It is all actually contributing to the economic growth only. So by reducing import, if you are cutting out on the choice and the ability of somebody to pay for a good quality product, you're actually cutting down on your own tax base as well. So the fillip really has to be to make our manufacturing and our exports competent enough that we increase the E of the formula rather than reduce the I in the same equation.
Okay. Imports are also down by 8.8% in the month of February. What exactly are the reasons for this contraction? What exactly is hurting the supply chain?
So we know for a fact that that we are not importing as much from China as we used to. While the number is still high, and the number is, I'll have to look into what are the elements which are leading to this reduction in import as well. But I think at a macro level, there is a sentiment to not buy the Chinese goods. While they're still flooded in the market, and there's no denying that that they're cheaper and they're more lucrative for people to buy. But I think the national sentiment around reducing import from China is something that could have led to to this little dip in the import figure. At the same time, we've got to look at the fuel prices also. So we're talking about a time in the wake of the Russia-Ukraine war last year when fuel prices had surged. So if you're looking at the dollar value of oil imports back in 2022 as compared to 2023, 1 year down the down the road when it comes to the Russia-Ukraine war, obviously oil prices have also stabilized over time, and they have seen their ups and downs, but oil is not as expensive as it was at the start of the Russia-Ukraine war. And it's around this time last year that the war had actually broken out. It's been a little over a year to the war. So oil prices become one critical element in understanding the import bill per se. But overall, you've got IKEA setting up shop in, hopefully soon in Greater Noida. We saw in the UP Investor Summit that announcement being made. Now, again, when it comes to foreign players setting up a base in India, the mandate on FDI rules is that 35% of what they sell should be produced in India. So all global players, we've seen the Apple, manufacturing shifting in fairly good measure to India, to a point that Indian-made Apple products were the highest exported Apple products, as compared to the other production centers and manufacturing centers that Apple runs across the world. So we are seeing that these are little elements which are going to protect India's interest and give a fillip to make in India and give a fillip to Indian manufacturing when you look at it. But I think largely the import would have, the reduction in the import bill marginal 8% would have stemmed from the oil prices.
Okay, so a decline there in both imports and exports, keeping the trade deficit to about $17.43 billion in the month of February. Obviously augurs well for the government and vindication to cut down excise duty on imports of non-essential products. Thanks very much, Karthik, with all those details.
Thanks, Shweta.
We're going to shift focus to Indian markets now. Indian markets snapped its 5-day losing streak to end a volatile session on a positive note. At close, the Sensex was down 0.14% to close at 57,634 level, and the 50-share Nifty was up by 0.08% to close below the psychological level of 17,000. The broader markets, however, were mixed, with Nifty Mid-Cap 100 closing on a flattish note, up 0.09%, and Nifty Small Cap 100 ending 0.52% lower. Among the top losers on Nifty were Hindalco, Tata Steel and IndusLink Bank, which fell 2 to 5%. On the other side, BPCL, Nestle, Asian Paints were among the top gainers, rising 2 to 6%. My colleague Suyash is with me in the newsroom to break it down for us, how exactly the markets performed. And also joining me, I'm told right now, is Lalit Shah. Suyash, over to you.
So it was indeed a volatile session for the market, Shweta, but we need to understand that much of the volatility was due to the weekly expiry of the derivatives contract. And now, even though the market did end on a flattish note, the bulls did manage to push back and snap the 5-day losing streak. Now, to provide some insight on the technical front, we have Lalit joining us. Lalit, how do you read today's expiry session?
Yeah, hi, Swash. Yeah, first of all, when the market opened, the sentiment was very negative due to the Credit Suisse news, which we have already discussed, that Saudi National Bank, their biggest backer, when they said that they can't put more money. So pressure was seen on all the banking ADRs in America. So in the night, I think all the banking shares, HDFC, ICICI, all ADRs were down around 4 to 5%. So in the morning, when market opened, the sentiment was really negative, and it opened below 17,694, and it went till 16,850. As already we have decided in the last time, that once market goes beyond 17,000, then 16,800 is the technical support, 16,800 to 850, and exactly what did the market did. So from 16,850 it bounced back, and the same case was with Bank Nifty. So there was a support at 38,500 due to this weekly expiry where put writing was done. So at around 38,600, Bank Nifty also made a sharp recovery, and in the end, after a volatile day, as due to the weekly expiry of Nifty and Bank Nifty, it almost closed flattish to little bit positive. Yes, Shivansh.
So there's a lot of uncertainty in the market. What do you think are some of the factors that will drive the market in the upcoming week?
See, the major factor is the Fed meeting, which is on 22nd March. So whoever has the position in banking Nifty, right? I should say either proper hedging should be done in their position, or the small traders should avoid dealing in Bank Nifty, as on 22nd, there will be major drive that what Fed is saying about the interest rate hikes and what they are seeing about the small banks, like which can go after SVB, which are in the fear. Investors are in the fear what will happen to some other bank. It may happen to some other bank also. So let us wait for the Fed meeting, which is the main drive. And after that, one can take trading positions in Bank Nifty. And as far as Nifty is concerned, I think there is absolutely no fear in Nifty, but the other factors like the Bank Nifty, due to which Nifty is also coming down. So technically, Nifty has a support of 16,800. Till the time it is holding 16,800, there is no such fear, and investors should look for a bounce back from here around 150 to 200 points. But I will say again that this monthly expiry can be very, very volatile, and small investors should just avoid the trade in intraday trades, I will say.
Thank you. The word on the street is that it would be a volatile upcoming week. Thank you for joining us, Lalit. Over to you, Shweta.
All right, Lalit, Suyash, thanks very much for joining us with all those details. And with that, it's a wrap on this edition of Business Plus. For more details, analysis and news, keep watching News 9 Plus. Thanks for watching.